DeWaal here, and this is Bridging the Week for December 7th to 11th, and today is December 14th, 2015. Good morning. The Securities and Exchange Commission proposed a rule that would restrict registered investment funds from transacting in derivatives. In France, one algorithmic trader and an exchange were sanctioned for certain high-speed trading activities, while in Canada, high-speed trading was initially praised by a regulator. However, later on the same day, the praise was retracted, and only certain of high-speed trading's beneficial impacts on markets were categorized. We have a potpourri of matters this week to cover, so let's get started. The Securities and Exchange Commission proposed a new rule aimed at limiting the leverage of registered investment companies could obtain through the use of derivatives or other transactions that have a potential deferred financial obligation, such as repurchase agreements and short sales termed financial commitment transactions. In addition, the SEC's proposed new rules would require investment companies to set aside in segregation qualifying assets to meet their mark-to-market liability, as well as to cover potential futures losses on derivatives and financial commitment transactions. Also, registered investment funds would be required to establish a formalized risk management program to manage the risk of derivatives and financial commitment transactions if they engage in more than a limited number of covered trades. Investment companies include mutual funds, exchange-traded funds, so-called ETFs, and closed-end funds. Companies that are elected to be treated as business development companies would also be impacted by the SEC's proposed new rules. Under the SEC's proposed new rules, a fund would have to comply with one of two leverage restrictions: an exposure-based limit or a risk-based portfolio limit. Under one of the limits, the former, a fund would have to limit its aggregate exposure to 150% of its net assets based on the notional amount of its derivative transactions and its obligation under its financial commitment and certain other transactions. Alternatively, a fund could obtain exposure derivatives up to 300% of its assets, provided the fund also meets a risk-based test. The goal through this test is to demonstrate that, in aggregate, the fund's portfolio is subject to less market risk by including derivatives than by not. A fund also would have to separately segregate qualifying high-quality assets in an amount it would have to pay to exit the derivatives transaction at the time of the determination, plus an additional amount derived from a reasonable estimate of what the fund might have to pay to liquidate its derivatives transactions under stress circumstances. Finally, a fund that undertook more than a limited number of derivatives transactions or used complex derivatives would have to maintain a formalized risk management program under the oversight of a designated risk manager. The program would have to be reasonably designed to assess, manage, and monitor the risk of derivatives transactions and to segregate function of regulated personnel. Formalized risk programs would require annual updates and review. The SEC will accept comments on its proposed new rule for 90 days after their publication in the Federal Register. Total Gas and Power North America, Inc. and Teresa Tran, a natural gas trading and marketing firm, and one of its traders, were charged by the Commodity Futures Trading Commission with attempting to manipulate natural gas monthly index settlement prices during 4 monthly periods in 2011 and 2012. According to the CFTC, Total Gas traded a very high volume of fixed-price natural gas contracts during the last week of 4 months in 2011 and 2012. This was done, alleged the CFTC, solely to influence the settlement of Total Gas's related financial basis and index swaps that were priced off the volume-weighted average price of all reported fixed-price transactions occurring during these month-end periods. The firm and trader simultaneously settled the CFTC's charges without admitting or denying any of the Commission's findings or conclusions, and by agreeing to pay a fine of $3.6 million and a 2-year prohibition on certain related trading activity. The French financial regulator, Autorité des Marchés Financiers, announced that it had penalized both Virtu Financial Europe and Euronext Paris €5 million over certain of Virtu's trading activities in 2009. According to the AMF, during the relevant time, Virtu very rapidly placed and canceled orders in 27 securities that, quote, distorted the representation of the order books for market participants, end of quote, and constituted market manipulation under applicable AMF regulation. During the relevant time, said AMF, Virtu's trades constituted 62.7% of all messages, but only 2% of all trades, while 66% of the firm's orders lasted less than 1 second, and 25% lasted less than 10 milliseconds. AMF claimed that Euronext permitted Virtu's violation by exempting the firm from its then prevailing maximum permitted daily ratio of orders placed to number of trades 100 to 1. According to AMF, through its conduct, Euronext did not operate, quote, with neutrality and impartiality in accordance with market integrity, end of quote. In response, Euronext issued a press release claiming that AMF's fine was totally disproportionate and completely anachronistic, and that it would appeal. And finally, the Investment Industry Regulation Organization of Canada, a self-regulatory organization, completed a study of high-frequency trading that, quote, did not reveal any concerns that warranted a regulatory response beyond measures already implemented by IIROC, end of quote. When IIROC initially issued a study on December 9th, it noted, quote, that the presence of HFT has different, mostly positive impacts on Canadian equity markets and those who invest on those markets, end of quote. Later the same day, IIROC retracted that statement and reissued it, deleting the words mostly positive. IIROC's study concluded that HFTs generally provide more liquidity and contribute, quote-unquote, substantially to price discovery, and that the, quote, majority of passive orders entered by HFTs either improve the best price or match the prevailing best prices, end of quote. IIROC also found that, quote, there is little evidence, end of quote, that HFTs front-run or otherwise take advantage of slower traders. IIROC's study examined the impact of HFTs on Canada's equity markets only. Well, that's it for this week's edition of Bridging the Week. As always, there is more information in each article and more articles on the article version of Bridging the Week on the website. Check it out. This is Gary DeWaal. Have a great week, and until next week, ciao.